Welcome to the InterMarket Analysis video update. This is a video that I do once a week where we look at other markets outside of the S&P 500 and even outside of the stock market. We also do a pretty in-depth analysis of earnings as they're looking right now, both on a historical basis and looking forward. And then I do another kind of in-depth study between growth versus value. When growth is outperforming value, that's more positive for the market. When value is outperforming growth, that's when the market is becoming more defensive. This is being prepared for Monday, January 13th. First area is S&P 500 valuation. This chart looks historically at earnings reports that have already come out. And we are coming right into the beginning of earnings season. So that'll be a big catalyst as we're working our way into the early part of 2025. But looking at these historical earnings, we can see where the black line, which is the S&P 500, is quite a bit above the red dashed line. That's a PE ratio of 20. That's usually the mark. When we get above 20, the market is considered to be expensive. When we're below that line, the market is more fairly priced. And we can ride this for a number of years. And we've been doing that. Now, since the market's been under pressure so far in 2025, this seems to be coming to the forefront, saying, oh, the market's expensive. It should be going down. The PE ratios are too high. And there's some justification for that, but you can see that we can be overvalued for a long time and the market can still go up, but we still want to be aware of this. This is another chart, the same information, but it's just showing some different events that have happened going back to 1980 and what the valuations were at that time. Then Robert Shiller developed a PE ratio that's a little bit different. It takes a more smooth approach with earnings and compares it to the price of the S&P. After Friday, we're coming in at 36.98. Now, it has fallen because stocks have been under pressure, but we're still getting a very high reading. Just to give us a little bit of perspective, we're between 16 and 17 with the median and the mean here, and we're still coming in at just under 37. So even this is showing that the market is overvalued. But we don't use this as a timing mechanism. We don't really say, okay, the market's expensive, it's time to get out. I use technical analysis to do that. This is just more for informational purposes to see, okay, how is the market looking on a valuation basis? Then we do what the stock market does. We look forward with forward PE ratios. And the red line is what I pay attention to the most because that's the forward PE ratio for the S&P. Even though the S&P has been pulling back, we're still over 20. We came in at 21.2. This purple line are the mega cap 8 stocks, the real big high flyers, the ones that really drive the market, and they're coming in at 29.5. Now we'd actually got above 30, but anything over 20 is considered to be expensive. So even though we've been under pressure, pulling back, we're still getting a very high reading. If you look down at the bottom with the green line and the blue line, that's the mid caps and the small caps. And they're more fairly priced, but interest rates going up, which has really been pressuring the market lately, that's been really holding the small caps and the mid caps back because they have to borrow a lot of money to be able to grow. And if they pay more in interest, that's less profits that they have, and it really can impact their bottom line. But we're coming in at 15.6 for the mid caps, 15.2 for the small caps. But then you have to look a little deeper with these small caps and mid caps to see, okay, is there earnings growth there? Are they seeing profits? Are they seeing the potential of maybe becoming a large cap stock somewhere in the future? So there's a lot more that goes into that. But we just want to be aware of this because the market feeds off of forward-looking earnings and then say, okay, are we coming down? Are we still expensive with the S&P 500? Yes, even though the market is coming down and when we look at the short and intermediate term, we're in a downtrend currently. Then I look at growth versus value. So first of all, we look at just a growth index itself. And this is still in an uptrend. It's been coming down. We're back down to the 50-day moving average, but the trend hasn't changed. We've been seeing a little bit more pressure with value, which in a more solid environment, when the market's really going up, we would see growth underperform here, and it's underneath its 50-day moving average. Then we do ratios between the two. On the top chart, when growth is outperforming value, this ratio goes up. And that's what's happening, even though the market's been under some pressure. Then we do an inverse of that same ratio down below, because sometimes you can get some insight when you look at the same thing, maybe upside down. It's like, oh, I see something that I didn't see before. Well, this is really just showing that value is underperforming growth. So this is still looking pretty solid. Then I look at a number of different indexes and even ETFs and compare growth with value to see, are we getting the same answers with all of the different things that we look at? Here is an index of growth to value on a ratio basis. When this is going up, that means growth is outperforming. When this is going down, that means value is underperforming. Here's another look at some ETFs showing growth is outperforming. Here's another one showing how value is underperforming. So we're seeing some confirmation, and then another look in different time frames for lengths of the chart. This still shows that growth is outperforming value. We look at a couple of big ETFs and we do a ratio between the two, getting a very high reading over here showing growth continues to outperform. This shows how value is underperforming. Then we look at the small caps, even though the index has really been under pressure and actually going down, the growth to value ratio has still stayed pretty strong. And this could be under the surface, hasn't transpired into anything yet. This really started to improve in November. So we've been looking at this improvement now for a number of months, but the index itself just hasn't really been performing. In fact, it's been underperforming. And the same thing with the mid caps, going sideways at best, but the growth to value ratio still looks pretty strong. Then I look at S&P growth to value. This is holding up a little bit better, not really breaking out to the upside, but it is also in an uptrend. So you would think at some point that this is going to really help the indexes to go higher. It's just gone on for a few months now and has really not had much of an impact in a positive way. We keep an eye on inflation. I first start out by looking at a very long-term chart. This is the CRB index, which are commodities, and they've been coming on strong. The economic reports that have been coming out have been stronger than expected. The Fed has come out and said, we're probably done cutting interest rates for the time being, and we're going to boost up our inflation outlook. Well, that's giving some support to commodities, and this is going back up here on the monthly chart. We look down at the bottom on inflation versus deflation and take a ratio. This continues to go down, even though it's been coming back up lately. So, yeah, the inflation is picking up some steam as measured by the CRB index and as measured by the ratio, but it hasn't really changed its overall environment, at least to this point. Here's a daily chart of the CRB index where it's been seeing some strength lately as other areas in the commodities markets have been going up. We keep an eye on inflation looking at the Baltic Dry Index. This is not really showing any inflation concerns. This chart is actually going down. Then what are the inflation expectations? This is measured by an ETF, and this is going up. And a lot of this advance came in Friday's session because the employment situation report came in a lot stronger than expected. That's spooking the bond market, making interest rates going up. And when interest rates continue to go up the way they have been, that's been pushing stocks down. We just want to keep an eye on some other markets. Aluminum is still in an uptrend, but it's falling underneath its 200-day moving average. Corn starting to go back up, still barely in a downtrend here, but if this continues to go up, and this could be considered inflationary because when corn costs more, there's so much food that's tied to corn, but this might switch over and actually continue to go up and be a little bit of a concern. Wheat, still in a downtrend though. Look at fertilizer, it has been going up in price, This is another potentially inflationary thing that the market keeps an eye on. And then oil's been going back up. Now, I've been watching this lately for geopolitical reasons, but this seems to be more technical. There are geopolitical things going on that have an impact on price, but there's been geopolitical things happening that's had no impact on the price of oil. But we had been spending a lot of time down around the 70 level. Now we're getting up into the 76 and a half level. We look at a ratio between gold to oil, and this has been coming down as gold. It's really been going sideways, but oil's been going up, and when that happens, that sees this ratio coming down. And then we look at oil, which is the red dashed line, and it's been going up. And we look at the 10-year yield, and it's been going up. And so we see the correlation between the two is really quite strong right now. We want to keep an eye on diesel because that what is a cost to ship products by trains and 18 wheelers. This has been coming down overall, but it's been going back up a little bit lately. And this is we're seeing some of the inflationary concerns coming into the market. Gas is still in a downtrend, but even it's been going back up lately. Heating oil still in a downtrend, but bouncing back up as well. We're seeing a lot of that right now. So this looks more reactionary and it's just kind of bouncing back up, but it's not really changing the trend. If we continue to see these areas like diesel here with heating oil, natural gas, things like that, then that's going to be more of a concern because that means the trend is actually going higher. And here is natural gas, where it's really been low. Now it's starting to go back up as well. And that's actually in an uptrend. We look at a copper to gold ratio, which continues to be quite weak. It bounced up a little bit recently because when you have a strong economy, copper tends to do better, and gold really hasn't been doing that much lately. So this ratio has been going down, meaning gold's outperforming copper. But over the last few sessions, we've seen a bounce with this ratio as copper's been outperforming gold. This is a longer term chart here, also plotted with the 10-year and the 2-year yield. We're seeing them going in opposite directions, and interest rates have been going up, and the copper to gold ratio is going down. When copper's outperforming gold, that means typically economic optimism going forward, and that means that the economy is growing, and that's when interest rates usually go up to try to keep inflation under control. Well, over the last couple of years, we've been seeing these going in the opposite direction. So we're keeping an eye on this, just seeing if the overall climate of the economy is switching to something a little bit more different. But we've been watching this now for a while, and it's not really making itself all that apparent. Here's copper itself. It's still in a downtrend because it had been really coming down. But you can see here, this past couple of sessions, it's really going up and getting back up to its 200-day moving average. Gold, seeing a little bit of a move back up here after it had dropped below its 50-day moving average. Silver actually fell below its 200-day moving average, but it's come back up and is not quite up again to its 50-day moving average. The closing price for gold on top, the closing price for silver in the middle area, and the correlation between the two is pretty strong. And that kind of is common sense. You think gold and silver tend to move together with each other. Then we have a gold to silver ratio on top. When this is going up, gold's outperforming. When this is going down, silver's outperforming. And then we can compare this ratio to the US dollar index. And there's a fairly high correlation between the two. This just looks at the interaction between precious metals and currency. The dollar's been really strong, and it could also be pressuring stocks lately. It just continues to really go up when you look at this chart by itself, and it's also in an uptrend on the weekly chart. Then, just to get an idea, we look at the euro on top and we look at the US dollar index, and these are pretty much mirror images of each other. We also put Japanese yen into the next chart, which has been going down. The euro's been going down as the dollar's been going up. And then I break these out based on individual currencies, where the euro to the dollar is in a downtrend, the dollar's been going up, and the euro's been going down in relation to each other. The yen is in a downtrend compared to the dollar, And the British pound is in a downtrend compared to the dollar. And we look at some different ways of analyzing the markets. This is the S&P 500 weighted index. That's the bar chart, and the red line is the equal weight version of the S&P. When this red line's coming down, that means the bigger part of the S&P 500 is underperforming. When with the bar chart, when it's going up, it's really the mega cap stocks, the really big companies that drive the index. It's been holding up a little bit better lately as the rest of the S&P has been seeing more weakness. And we look at a ratio, when this is going down, that means the equal weight is underperforming the S&P. Now we did bounce a little bit on Friday because everything got hit in Friday's session. But this just means the rest of the S&P is underperforming the really big stocks. We look at a ratio between stocks and commodities coming down to actually dropping a little bit below the 200-day moving average with this ratio as commodities have been going up and stocks have been going down. This confirms that too. Here's an inverse showing how commodities longer term are underperforming stocks, but lately bouncing back up and looking a little stronger. We look at another ratio between the Nasdaq 100 growth stocks and the S&P, which is also built with growth stocks, but there's also value stocks in there. When this ratio is going up, that means the Nasdaq 100 is outperforming the S&P 500. Then the Nasdaq is outperforming the S&P 500, another growth area. This is still holding up well and more positive for the market. The big stocks that make up the S&P 500, that's the S&P 100, even though this is pulling back, still holding up. And then the Nasdaq 100, and this has been a shift that we saw about midway through 2024, when the Nasdaq 100 is now underperforming the Nasdaq. The Nasdaq itself, which is a much bigger and broader index, but it's mostly tech, that's been outperforming. And so we're seeing this ratio going down. We're looking at mega caps and compared to the equal weight index. Even though it's pulling back now, this is still holding up, hasn't changed its trend. Small caps continue to really underperform the S&P, and this has been a real disappointment to the market. In December and then into January, a lot of folks were really optimistic about the small caps. Well, because interest rates are going up and smaller companies have to borrow so much, that's been really pressuring small caps to go up. And in fact, they're now starting to go down. There's another ratio between small caps and the S&P. This red line continues to go down overall compared to the blue line, which is the S&P itself. Mega cap coming back to its 50-day moving average, but still in a really solid uptrend. The robotics and AI ETF just kind of chopping around inside of the rainbow and actually underperforming when we compare it to the tech sector. And we've been seeing that for quite a while. The Dow Jones Composite Average takes the Dow, the transports, and the utilities and puts them together. Still in an uptrend. Been looking pretty solid here. Now dropping below its 50-day moving average, but still above the 200-day moving average. Then here's the Wilshire 5000. This is a broad market measure that we look at, and we lost the 50-day moving average, but we're still in an uptrend because the blue line's above the red line. Total US stock ETF, another broad market measure, also below its 50-day moving average, but still in an uptrend. Low volatility stocks, these tend to do well when the market's getting ready to go down. And for most of 2024, if you look at this all by itself, it was in a really solid uptrend. Now it's coming back down to its 200-day moving average. We'll be waiting to see, are we going to hit this and bounce up and show good support here, or are we going to fall down below the 200-day moving average? But where we get some insight for what we're looking at is when we do a ratio between low volatility stocks, which are more defensive, and the S&P 500. This ratio continues to go down. Now, just to give you an idea, a lot of people are trying to compare the end of 2021 and the early part of 2022 with what's happening right now. Well, look at what was happening at that time. We were going down with this ratio, but then we saw this really shift and jump over into an uptrend. So far, we're still going down. with this ratio. So it's not necessarily a good comparison, but this could change. And if this ratio really starts to go back up and goes into an uptrend, that will cause us more concern, but we're just not seeing that at least yet. This has been a little bit of a concern. The advanced decline line studies were below the moving averages with all the indexes that we follow, and we're continuing to decline. Transports just kind of going sideways right now. They see a little bit of life. They came back, set an all-time high. Since that time, they pulled back and have just been chopping. We look at traditional Dow theory, which looks at the Dow on top, which the Dow's been under pressure. The transports have been going sideways. Utilities were strong, but pulling back and now starting to see some more weakness. And we look at a ratio between the transports and the S&P 500. When this is going down, that means the transports are underperforming. It's bouncing back up lately, but we've seen that before, only to have it turn and continue to go down. Then we look at a ratio between the Dow and the transports. And when this is going up, that means the Dow's outperforming. We did blip down a little bit as transports went through kind of a short, good time, but now we're starting to come back down again. And we look at the S&P on top, the transports in the middle, and we see there's a pretty high correlation between the two, meaning that they're usually going up or down at the same time, not in opposite directions. This is a chart that I found throughout last week. This compares the S&P 500 performance here with the Dow Jones Transportation Index that we just looked at. And you can see there's a really big disconnect between the two. Other times, they tend to move in the same basic direction and they tend to perform about the same or at least comparable to each other. Going back to the last part of 2023, we've seen where the S&P's been doing really well as the transports were going sideways, and that's causing some folks to be concerned. And let's see, went the wrong way there. Now, a variation of Dow theory could be instead of using the Dow, we use the S&P 500. And instead of using the transports, we use the NASDAQ. Both have been pulling back. We're not really seeing any major divergences here. This is a further breakdown of that, where we use the equal weight version of the S&P, pulling back, and then an equal weight version of the NASDAQ 100 or the QQQs. That's also been pulling back. So we're not really getting any insight that we're not seeing with other charts right now. This is a stronger part of the market. This is the FANG index, the really big mega cap stocks, still above its 50-day moving average, even though it's been coming down and we're setting a series of lower highs and lower lows. That's concerning, but we're still hanging out above this support level for the time being. So it's not seeing as much weakness right now as what we're seeing in other areas of the market. And we're coming down to this longer term trend line. If we continue to fall, so far, we've been able to hold at this support level. So we'll see if that can continue. If we break this support and then really start to shift over and look more negative, that's going to have a real impact on the market. If this can hold up a little bit better, that would have more of a positive impact on the market. ARC is still in an uptrend, coming back down to its 50-day moving average. Then we look at an all-world ETF, but we take out U.S. stocks. These are showing some weakness, and we're just about getting ready to see a death cross here. And then we compare this to U.S. stocks, showing that U.S. stocks are still holding up. Even though they've been under pressure, they're still doing better than stocks throughout the rest of the world. We look at small caps to the tech sector, not really showing anything here. Small caps continue to underperform. And here's a longer term chart where we look at US stocks versus world stocks, showing that the US stocks are really outperforming and the momentum of this ratio continues to be up. Then we keep an eye on bonds, and this is interesting here. This is a 7 to 10 year bond ETF. This is bonds based on price. Just about ready to see a death cross here. And now bonds have already been going down based on price, and that's already been a concern. But is this getting ready to be an even bigger concern if we actually switch over into a downtrend? Total bond ETF, and I've been showing this chart in the daily videos. The hope was that we would come down to the 200-day moving average and then bounce up off of that. That's not what's happening right now. We're actually breaking further below the 200-day moving average because when bonds go down in price, they go up in yield or interest rates. The Pring World Bond Index is now in a downtrend based on price. But when we look at a longer term chart of a stock to bond ratio, even though stocks have been under pressure, bonds have been under even more pressure, and this ratio continues to go up. This is a daily chart showing how bonds continue to underperform stocks and it's bonds based on price. High yield bonds, which are junk bonds, these are holding up a bit better. This chart tends to follow what the stock market's doing. And folks are preferring to get into junk bonds right now because they're willing to take on that risk, but they want that higher yield. These are more conservative bonds here, where we're seeing some weakness right now, dropping below the 200-day moving average and in a weakening uptrend currently. Corporate bonds also in an uptrend, but really showing some weakness, dropping below their 200-day moving average. Here's the 10-year yield with some fib retracement levels on here, but even though we're going up, we're not really close to that line, at least yet. This line is at about 5%. And looking at what we're seeing getting into a higher range now for interest rates after we had seen 40 years of lower highs and lower lows. Now we're shifting back over to where interest rates are actually more in a higher environment right now. And this is one that I'm keeping an eye on. I'm just watching the 30-year yield, not necessarily this chart because we're not really close to any of these lines. But the 30-year yield is getting really close to 5%, and that could be a big deal to the market. I usually focus on the 10-year yield and how that's acting, but since we're getting up to that 5% level with the 30-year, we want to see, are we going to come up to that level and then come back down with yield, or are we going to break through the 5% level? That could really have a major impact on stocks. Junk bonds are still doing quite well, even though they're under their 50-day moving average. And junk bonds, more risky bonds, are outperforming more conservative bonds or government bonds. Then this is what we've been seeing. The interest rate environment was really looking more friendly for stocks as they were coming down. This was the market anticipating the Fed cutting rates. And then last fall in September, they cut those rates. Well, the Fed has rates coming down, but right after that, interest rates started to go back up. And that the market didn't pay all that much of attention to it, the stock market anyway. Stocks were still going up and looking pretty good. And then interest rates came down as we were starting out the month of December. That helped stocks perform quite well. But then with these stronger than expected economic reports that have been coming out, that's been pushing interest rates back up. And finally, we got to the point where we broke above the 4.5 level with the 10-year yield, and stocks went, wait a minute here. Interest rates are going up. We shouldn't be buying stocks. We should be selling stocks. And that's been the under the surface pressure that's been bringing stocks down as interest rates have been going up. And we want to keep an eye on this. This is a weekly chart of international rates, and we have US, UK rates going up, German rates going up. It's Japanese rates we want to watch because this is getting further above this 1% level, which may not seem like that big of a deal, but last summer when this got up over 1%. This is what freaked out the markets. And we had that really, really bad day, August 5th, and everybody was talking about it. And the VIX really shot up and stocks really went down. And then we were able to bounce up out of that. Well, this red line continues to go up. And is that problem going to come about again that started in Japan and just flowed through the whole globe? So we're just watching this to see if something like that does happen. And we look at the volatility of bonds on top, that's the move index. And then the volatility of stocks, that's in the middle area, that's the VIX. And then we see that there's a pretty high correlation between the volatility of the two. Not really strong, but if bonds get volatile, stocks are tending to get volatile at the same time. We do a ratio between the S&P 500 and short-term bonds. Yeah, coming back down into the rainbow now after it had been stronger. And we look at a broad market measure, the S&P 1500 to short-term bonds, also coming back down into the rainbow as stocks have been going down and interest rates have been going up. But this is the 1 to 3 bond ETF. This is bonds based on price. And when this goes down, that means that even though price is going down, stock prices are going down even more right now. We're wondering if we're going to be able to bounce up out of this. Another broad market measure with further out bonds also showing some recent weakness as the stock market's been under pressure. The tech sector still looking fairly solid right now, even though it's been pulling back into the rainbow when we compare it to 3 to 7 year bonds. Riskier bonds are continuing to outperform more conservative bonds. Folks want that yield and they're willing to take on that risk. We look at a stock to bond correlation. It had been neutral for a while. Now it's starting to get to the point where we're seeing the price of stocks and the price of bonds showing a stronger correlated relationship. They're either going up or down at the same time together. And then we look at a ratio between 3 to 7 year bonds and stocks. Even though this has been bouncing back up, bonds continue to underperform. We look at stocks versus the 10-year yield. Stocks have been outperforming as interest rates have been going back up. We're seeing this ratio going down. And then we look at a long-term price of the 30-year bond, which is now going back into a downtrend. And we look at another ratio between the long-term bond price and commodities. This is still in an uptrend, but starting to show some weakness, as we've been seeing weakness in bond prices, even in the long term, and strength in commodities. And I looked at different sectors. We look at the material sector, which is in a downtrend right now. And then we do a ratio between the materials sector and the S&P, showing how materials are underperforming. Communication, a growth area. This is a bit of a concern. We've dropped under the 50-day moving average with the communication sector, but it's still outperforming the S&P. And this is one of the stronger areas. And we want this to look positive and to stay positive. That can help the indexes to go up. Energy, which has really been under a lot of pressure, coming back and bouncing. When we see more inflation, when interest rates are going up, energy tends to perform better. We're still below the 50 and 200-day moving averages, and we're just barely hanging on to an uptrend here. But you can see how energies, as the interest rates started to go up, interest rates started to go up as well. But when we can do it, when we compare this on a ratio basis with the energy sector to the S&P, bouncing back up, but still in a downtrend. Financials, which have been a stronger area, falling further below their 50-day moving average, but still outperforming, even though showing some weakness here when compared to the S&P. Industrials, kind of going sideways after dropping below their 50-day moving average, and actually just starting a recent downtrend here when we do a look at this ratio between industrials and the S&P. The tech sector pulling back, falling under its 50-day moving average, and pretty much going sideways when we compare it to the S&P and also in a downtrend right now. Earlier in the year, tech really outperformed. We hit a top there and we've been chopping sideways ever since. And as the market's been under pressure, that really is a large part being caused by tech being under pressure as well, because it's such a huge part of the stock market. Staples, a more defensive area. I've also been watching this chart in the daily videos because I thought maybe we would hold out above the 200-day moving average. Nope, we're breaking down. Now, this is probably kind of a positive thing because staples are more defensive. And if staples are going down, that means the market is not necessarily getting defensive. If you look back in the end of 2021, staples were in a solid uptrend. And then we went into 2022 where they held up better than the rest of the market. They've been in a solid uptrend for 2024, excuse me. But now that they're pulling back, this could actually be a little bit positive for stocks. Then we look at the staples to S&P ratio, showing how staples are underperforming. Real estate does not like interest rates going up and really underperforming the S&P. This is when we look at real estate by itself. It's falling underneath its 200-day moving average. Utilities were really strong, pulling back, still under its 50-day moving average. And we're just about ready to see a death cross here when we do a ratio between utilities and the S&P. Then we look at another ratio between the S&P and utilities. When this is going up, that means the S&P is outperforming. When this is going down, that means utilities are outperforming. We're just kind of chopping around right now. So we're not getting a lot of great insight from this chart. And healthcare, which is a defensive area, in a downtrend right now and continuing to underperform the S&P, even though it had a pretty good week this past week, it's coming back up to its 50-day moving average with this ratio. Discretionary coming down and right at its 50-day moving average. We're going to be watching this to see if we can get a bounce up off of that because discretionary has been one of the stronger areas since we had that big down move in August. It's been the best performing sector since August. And it's still looking pretty good, even though showing some weakness here when we compare it to the S&P. And then I watch a lot of these different things, and I go through more charts in the daily video because I've been really honing in on this. This is the SOX index, which is in a downtrend right now. These are the semiconductors. Now, I have other indexes and other ways of looking at the semiconductors, like with another ETF. Those are in uptrends, but this one is a little bit more of a concern. We're in a downtrend here, and we're now falling back below the 50-day moving average. We look at a ratio between energy, which is bouncing back up lately when compared to tech, but longer term, energy is underperforming. Growth stocks versus bonds, more conservative. This is showing that even with the recent weakness here, growth stocks are continuing to outperform. Then we look at a relationship between the tech sector and the 10-year yield. Tech sector has been outperforming, but as interest rates have been going up and tech has been going down, we're seeing some weakness with this ratio. And we'll keep watching this to see is the overall environment changing or are we just seeing normal pullback and normal weakness? This is that same thing where the 10-year yield has been underperforming the tech sector, but showing some recent strength. Discretionary to staples, this is holding up quite well. Even though it's not really breaking out to the upside, it's still in a longer term uptrend. This is that same thing showing how staples are underperforming discretionary. So the market's not getting defensive, it's still on offense. So that is more positive for the market, at least right now. Now, we watch this, and that's why I do this video every week to see is this overall relationship changing. And so far, it's showing some weakness, going through some difficult times, but the overall relationship is not changing. It's more in growth mode. Then we compare gold to the S&P 500, still pretty much chopping sideways. We also look at gold to the dollar. When this is coming down, gold's been not doing as well as it was before, and the dollar's been really strong. That's why we see this ratio coming down. High leverage loans, another barometer that we can use for the economy, not even back down to its 50-day moving average yet. The NYSE composite underneath its 50-day moving average, but still above its 200-day moving average. All stocks, the same thing. You're going to see a lot of this with the stock indexes that we look at. Some weakness here, but still in an uptrend and still above its 200-day moving average. Emerging markets looking a little more weak, dropping below its 200-day moving average. Still in an uptrend, but that is looking a little vulnerable right now. And we're still getting very high readings with the Japanese Nikkei index. That's holding out around the previous all-time high set back in 1989. The microcaps pulling back under their 50-day moving average, but still in an uptrend. Bitcoin got up above 100,000, then pulled back. Then it spent a little bit of time above 100,000. Now it's pulling back again. And we want to keep an eye on the relationship between the S&P and the home builders ETF because real estate has been under a lot of pressure. It's more neutral right now with this correlation. So we're just keeping an eye on this. This doesn't like interest rates going up either. The home builders, they prefer a more interest rate friendly environment. And then because we're still just starting with 2025, I'm still going back to the beginning of 2024 with this chart. Gold is performing the best, followed by stocks. Then oil's been coming on strong lately. Then you have the dollar, and then bonds based on price are negative. Probably I'll switch this chart over after we get through the month of January. And we're seeing some weakness with a very long-term oscillator here, the KST. We're rolling over in China. We're already in a downtrend with emerging markets. We're going down in Europe and Japan and in the US right now. Then we keep an eye on some correlations between stocks, the S&P, and oil. They're actually having a slight tendency to go in opposite directions right now because oil's been going up as the S&P's been going down. And keeping another close eye on the S&P and the dollar. Now, the stock market likes a weaker dollar, but now it doesn't seem to really matter. They're having a tendency to go in opposite directions. So stocks have been going down as the dollar's been going up. And I guess that would be more of a powerful correlation between the two. And we look at the S&P 500 and the 10-year yield. It had been neutral, not really showing that big of a correlation right now. Also, not a real big correlation between the tech sector and the 10-year yield. Keeping an eye on the S&P and the 2-year yield, it's pretty much neutral right now. We'll see if this shifts over and gives us some more insight. Some long-term charts here. This is a monthly chart of the NYSE coming back down to its 12-month moving average here, showing a little bit of vulnerability as far as momentum. There's a daily chart with the NYSE composite, and this NYSE record high percent index has been coming down and showing some weakness. Then the S&P monthly chart here, still above its 12-month moving average, but we're seeing some vulnerability when we look at this on a momentum basis. That's starting to roll over. And then we look at a ratio between stocks and commodities like we saw before, rolling over, but still showing that stocks are outperforming commodities. A long-term global chart here, US stocks are still holding up better than stocks throughout the whole globe. The KST is also proving that US stocks on a momentum basis are outperforming. Then at the end, I go through the positive things, and we still have a pretty long list here. When you look at growth to value by themselves, they're in uptrends, and that's when the 50-day moving average is above the 200-day moving average. The dollar is looking strong, the CRB index, gold, silver, the mega caps, the FANG index, ARC, low volatility ETF by itself. Staples are still in an uptrend, the Dow Jones Composite Average, bonds based on price, with pretty much everything except emerging markets. The tech sector, high leverage loans, the Dow, the NYSE Composite and Wilshire, NASDAQ and NASDAQ 100, the mid caps, small caps, and micro caps, all stocks, emerging markets, and Bitcoin. So these are all positive. They've been taking a hit lately, and we're waiting to see if this list gets shorter as things turn more negative, but it hasn't happened yet. Then, when the 50-day moving average is below the 200-day moving average, this is what's negative. Now, copper is still in a downtrend, but it's seeing some recent strength. But we're waiting to see, is that going to be enough to turn it to an uptrend? Because if the economy's looking strong, then copper should be looking strong as well. The euro, the yen, the British pound, when compared to the US dollar. And then when you look at the SOX index, which is a semiconductor index, but the other indexes and other ETFs that I look at, those are still positive. So we're getting a mixed picture there. And that's why I've been going through this in every one of the daily videos. The World Bond Index, these are bonds based on price, are in a downtrend. Thank you. I hope you found this helpful. I hope you're having a great weekend, and I will talk to you in the next video.